Welcome to our comprehensive guide on Kansas tax residency. Whether you're moving to Kansas for work, retirement, or simply a change of scenery, understanding your tax residency status is crucial. This status can significantly impact your financial obligations to the state, determining your income tax filing requirements and affecting how much tax you owe. In this video, we'll explore everything you need to know about establishing tax residency in Kansas, including the mandatory requirements and potential pitfalls to avoid. Let's dive in to learn about how Kansas determines who qualifies as a tax resident and why getting this right is essential for your financial future. First, let's clarify what tax residency means. Tax residency is distinct from other types of residency, such as legal or voting residency. As a tax resident of Kansas, you will be subject to state income tax on all your income, regardless of where it was earned. This means that even if you have homes in multiple states or spend considerable time outside Kansas, you could still be considered a tax resident if you meet specific conditions. Kansas utilizes two primary tests to establish tax residency: the Domicile test and the Statutory residency test. It's important to understand how these apply to you in order to effectively manage your tax obligations. We begin with the Kansas Domicile test. Your domicile is your permanent legal home, essentially the place you intend to return to after any temporary absences. Establishing your domicile in Kansas requires more than just declaring it as your home. You must demonstrate both a physical move and an intent to make it your permanent residence. This involves making significant connections to the state, like getting a driver's license, registering to vote, or changing your mailing address. Understanding these nuances can prevent misunderstandings with tax authorities and ensure that you're in compliance. Next, let's discuss the Kansas Statutory Residency Test, which can apply even if your domicile is elsewhere. Kansas uses the common 183-day rule, used by many states, which counts any part of a day spent in-state towards your residency status. If you spend more than 183 days in Kansas during a tax year, you may be classified as a statutory resident. This can have substantial implications, especially if you travel frequently or split your time between states. To manage your tax status effectively, consider using a residency tracking app to record your time spent in Kansas and other states to avoid being caught off guard by unexpected tax obligations. Lastly, let's touch on how to establish your Kansas residency through proper documentation. To establish Kansas residency for tax purposes, it's important to gather evidence that shows your connections to the state. This can include utility bills, bank statements, and other official documents that indicate your presence and intent to stay in Kansas. If you become a part-year resident, you will need to report your income from Kansas for only part of the year, while ensuring compliance with both Kansas and federal tax requirements. This is a crucial step for making sure you're paying the right amount of tax and avoiding penalties.